Imagine two Americans with nearly identical lives. They earn about the same salary, work similar jobs, and live in the same city. Fast forward 30 years, and their futures couldn't look more different. One retires with confidence, knowing their investments can support the life they've worked so hard to build. The other reaches retirement, wondering why decades of paychecks never turned into lasting financial security. What caused such a dramatic difference? It wasn't a winning lottery ticket, a six-figure raise, or some secret Wall Street strategy. It started with ordinary decisions that seemed far too small to matter. Think about the last time you stopped at a convenience store after work. You grab a cold drink from the cooler, maybe a bag of chips, or a candy bar sitting next to the register. The cashier asks if you want a scratch-off ticket, and for a moment, it seems harmless. After all, it's only a few dollars. You pay, leave the store, and by tomorrow, you've probably forgotten the purchase ever happened. That's exactly why these decisions are so powerful. The financial choices that shape our future rarely feel important in the moment. They don't come with flashing warning signs or dramatic consequences. Instead, they hide inside everyday routines, so familiar that we barely notice them. A few dollars here, a quick purchase there. One small expense doesn't seem capable of changing your life. But when those tiny decisions are repeated thousands of times over many years, they quietly begin writing your financial story. Modern life has made spending easier than at any other point in history. Every shopping app is designed to remove friction. One tap is enough to place an order. Streaming subscriptions, renew automatically, digital wallets, let us spend without ever touching cash. Stores are carefully arranged to encourage one more purchase before we walk out the door, while advertisements compete every second for our attention. Convenience has become so effortless that spending often happens before we even stop to think. When people struggle financially, it's easy to blame inflation, rising housing costs, or wages that haven't kept pace with expenses. Those challenges are real, but they don't explain everything. Hidden beneath the obvious reasons is another force that's much harder to notice. Thousands of everyday financial decisions that feel completely insignificant on their own, but become incredibly powerful when repeated year after year. Picture two co-workers leaving the office every evening. They earn similar incomes and share nearly identical lifestyles. On the drive home, both stop at the same convenience store. One spends $5 on a drink and whatever catches their eye. Near the checkout counter, the other skips the purchase and automatically invests that same $5 into a low-cost index fund. At first, the difference is almost invisible. After a month, nothing seems to have changed. Even after a full year, the investment account still looks surprisingly ordinary. Most people wouldn't be impressed by the balance, and some might even laugh at the idea that $5 a day could ever make a meaningful difference compared to the instant satisfaction of buying something today. Patient investing feels slow, boring, and almost pointless. But this is where psychology quietly takes control. Behavioral economists describe a tendency called present bias. It's our natural habit of valuing rewards we can enjoy right now far more than benefits we'll receive years from today. That simple instinct explains why building wealth is often harder than understanding how to build it. Most people already know they should save, invest, and think long-term. The challenge isn't knowledge, it's human nature. Our brains evolved to chase immediate rewards while treating distant benefits as if they barely exist. And that's the lesson many people overlook. The first year of investing isn't really about growing your portfolio. The numbers may still look small, but something much more important is happening beneath the surface. You're building a new identity. Every automatic investment reinforces the habit of choosing your future instead of your impulses. Long before compound interest begins transforming your money, consistency begins transforming you. In personal finance, lasting wealth rarely begins with one brilliant decision. It begins with small actions repeated so consistently that they become part of who you are. By the time the financial results become obvious, the habit has already changed your future. 5 years pass, almost without you noticing. That small daily investment still doesn't feel large enough to change your lifestyle. But something important has happened behind the scenes. For the first time, your account is growing. For more than just the money you've contributed, a meaningful portion of your balance now comes from investment returns, working quietly on your behalf. The change is easy to miss because it happens gradually, not overnight. There isn't a single moment when everything suddenly looks different. Instead, progress builds so slowly that most people don't recognize it until years have already passed. Around the same time, you'll probably watch friends and coworkers chase the newest investing trend. One year, it's a hot technology stock. The next, it's cryptocurrency, artificial intelligence companies, meme stocks, or another opportunity, promising incredible returns in just a few months. Every market cycle creates a new shortcut to wealth, and during a bull market, those shortcuts can seem impossible to ignore. Social media fills with stories of overnight success, making patient investing feel outdated and boring. But history tells a different story. From the dot-com bubble of the late 1990s to the housing crash of 2008 and countless speculative frenzies since then, investors have repeatedly learned the same lesson. Assets that rise the fastest often fall just as quickly. Excitement attracts attention, but consistency creates wealth. The people who quietly built the financial independence rarely did it by jumping from one trend to another. They simply gave ordinary investments enough time to produce extraordinary results. Of course, the journey isn't always easy. There will be years when making the right financial decision feels like the wrong one. Markets decline, retirement accounts lose value, financial news fills every screen with predictions of recessions, crashes, and economic uncertainty. During those moments, fear spreads faster than facts. It's completely natural to wonder if you should sell before things get even worse. Behavioral economists call this loss aversion. Human beings feel the pain of losing money far more intensely than the satisfaction of gaining the same amount. That emotional imbalance causes countless investors to panic after prices have already fallen, locking in losses that might have recovered with time. Ironically, some of history's best long-term buying opportunities have arrived during periods when fear was at its highest. The investors who benefited weren't necessarily smarter than everyone else. They were simply disciplined enough to stick with their plan when emotions told them to quit. Then, almost without warning, 2 or 3 decades pass. This is where the true power of compounding begins to reveal itself. Your monthly contributions become only a small part of the account's overall growth. In many years, your investments earn more than you could realistically save from your paycheck alone. At that point, compound interest is no longer just a concept from a personal finance book. It's a financial engine working around the clock, allowing your money to generate even more money with every passing year. That's why so many people never experience compounding at its full potential. The problem usually isn't a lack of intelligence or financial knowledge. It's impatience. People expect dramatic results too soon. When progress feels slow, they assume the strategy isn't working. They stop investing, change plans, or chase something more exciting just before time begins rewarding their consistency. More fortunes have been lost through impatience than through a single disastrous investment. If there's one lesson worth remembering, it's this. Make investing automatic. Start with an amount that comfortably fits your budget, whether it's $5 a day or $50 a week. Invest in a diversified, low-cost index fund. Keep contributing during strong markets and weak ones. Remove emotion from the process. Trust the long-term plan and give time the opportunity to do what no investor can accomplish alone. Years from now, you'll realize the greatest investment was never just the money you contributed. It was the habit you built. Every small decision to invest instead of spend became a vote for the future you wanted to create. Financial freedom rarely arrives because of one brilliant move or one lucky break. It grows quietly through thousands of ordinary choices that seem insignificant in the moment until one day you look back and realize those small decisions transformed your entire financial life.